The market just ran the same play 3 times in 2025. It worshipped mega-cap AI, it punished anything outside the spotlight, and it dumped 3 profitable businesses like they were uninvestable. That is what happened. Crocs got hit because one acquisition disappointed. JD.com got hit because it has China on the label. Oracle got hit because it spent aggressively on AI infrastructure, and investors saw the bill before they saw the payoff. I'm your host, and you're watching a fast, no-fluff breakdown of what the crowd is missing and where the value could be hiding right now. Because here's the trap at all-time highs. When prices are elevated, people stop asking, what is this business worth? And start asking, what's already going up? They confuse momentum with safety. They confuse popularity with quality. And they confuse a falling stock with a failing company. The stock market is a mood engine. In the short run, it votes with emotion. In the long run, it weighs with cash flow. When those two drift apart, that's where investors get paid. Not by being loud, by being early. So today, we're doing the opposite of what social media is trained to do. We're not chasing what already ran. We're not buying the cool chart. We're walking straight into the unloved aisle and asking one brutal question for each company. What are you getting? And what are you paying? And don't blink, because the most important part of this video isn't the names. It's the mechanism. It's how narratives create mispricings and how you can spot the moment the narrative cracks. Let's start with the stock that people laugh at, which is exactly why it's interesting. Crocs. Yes, the foam clogs, the punchline shoe. I can't believe this is a business. And that surface-level mockery is the first reason the market misprices it. Investors treat it like a fad, like a single-product gimmick, like a brand that could disappear the moment the internet gets bored. But fads don't usually post industrial-grade margins. Crocs has been operating with gross margins that most consumer footwear brands would kill for. That's not a vibe. That's a signal. High gross margin means customers are willing to pay far above the cost of production. It means the brand can raise prices without instantly losing demand. It means the product is not just a shoe, it's a decision people choose repeatedly. So why did the stock take a beating? Because the market saw a crack in the story. Crocs bought Hey Dude to broaden the portfolio and open new growth lanes. Instead, Hey Dude slowed down hard. Revenue sagged. The brand underdelivered, and Crocs took a big write-down that turned into a headline grenade. Here's the critical detail. A write-down can crush reported earnings while barely touching the actual cash the business generates. Accounting is not cash. The income statement can look like a disaster while the cash register still rings. This is where retail investors get tricked. They see a scary EPS number, they assume the business is bleeding, they hit sell. Meanwhile, the company is still producing cash flow and using it to reduce share count. But this is not a fairy tale. There is real risk here, and you need to face it head on. Crocs carries debt. Debt is not evil, but debt is a timer. Debt forces you to perform on schedule. If demand weakens and stays weak, debt turns from manageable into controlling. So the question is not, do I like Crocs? The question is, does Crocs have enough durable cash generation to keep paying down debt, keep buying back shares, and keep investing, even if growth stalls? Let's do a mental stress test. Imagine Crocs doesn't grow. Imagine the market is right that the growth story is slower. Even then, a high cash flow business can be a fantastic investment if you buy it cheap enough. This is the concept most people refuse to learn. They treat decline as automatically bad. But investing is not morality. It is math. A declining business can still be a great deal at the right price, and a growing business can be a terrible deal at the wrong price. If a company generates meaningful free cash flow for several years, those cash flows are real value, even if the terminal value is lower than the past. The only thing that changes is what you should pay today. Now look at what Crocs has been doing with cash flow. It hasn't been begging for rescue. It hasn't been issuing shares like confetti. It has been shrinking the share count and working the debt down. That matters, because buybacks at depressed prices are like buying future earnings for a discount. But not all buybacks are equal. Buybacks only create value when the stock is undervalued relative to future cash flows. Buybacks at expensive valuations are a silent tax on shareholders. So we have to check the price tag. When a stock trades at a low multiple of free cash flow, the market is saying one thing: we don't believe this cash will last. Sometimes that's true. Sometimes the business is a melting ice cube. But sometimes the market is projecting a temporary issue into a permanent obituary. That's where value shows up. The Crocs bear case is simple. The brand fades. Hey, dude, keep sliding. Fashion cycles shift. Competition pressures pricing. Debt becomes heavier. Cash flow shrinks. The Crocs bull case is also simple. Core brand stays resilient. Hey, dude stabilizes or gets fixed. The company keeps buying back shares. Debt comes down. And at a low valuation, you don't need perfection. You just need not a disaster. And here's the cliffhanger that makes Crocs worth watching. Consumer brands don't usually die quietly while they still have pricing power. They die when relevance collapses. Crocs hasn't lost relevance. It lost narrative momentum. Narrative momentum is not cash flow. So what should you watch like a hawk? Watch the core Crocs brand revenue trend, not one quarter. The slope over several quarters. Watch gross margin stability. If margins crack, that's the first real sign the moat is weakening. Watch inventory discipline. If inventories balloon, discounting follows and margins get hit. Watch the share count. If they keep retiring shares while the market is pessimistic, they're concentrating ownership for the survivors. And watch debt pay down. The faster debt comes down, the less fragile the story becomes. Now I want to pin you down with a question that forces clarity. Answer it in the comments. Would you rather own a cool stock at a premium valuation or an uncool cash flow machine at a discount? Because Crocs is the uncool test. And if you think Crocs is uncomfortable, the next one is even more uncomfortable because it isn't just about products. It's about geopolitics. JD, Kamauers, let's be honest. The market has treated Chinese stocks like they are cursed. The business can be profitable. The cash flow can be real. The scale can be enormous. None of it matters if investors believe the risk is unpriceable. That's what happened to JD. It got sold not because its warehouses stopped working, but because the world got spooked. And that fear is not imaginary. There are real risks, policy and regulatory risk, macro slowdown risk, competitive intensity, currency concerns, investor sentiment swings, delisting headlines. And the big one, the simple fact that many investors don't want exposure, period. So why is JD worth analyzing at all? Because fear creates discounts, and discounts create optionality. JD is not just another e-commerce site. Its competitive edge is its logistics infrastructure, warehouses, delivery networks, fulfillment speed, automation, the expensive physical backbone that makes customers trust the platform. That infrastructure is a moat. You can't copy it with a marketing budget. You have to build it, operate it, and scale it. That takes time and capital. This is why JD often runs on thin margins. Logistics-heavy businesses trade margin for reliability and speed. The margin shows up later as efficiency improves and scale compresses unit costs. Investors hate waiting. Businesses don't care. Now, the market's discount on JD is basically a risk premium. Investors are applying a higher required return because the uncertainty feels bigger. That is rational. The mistake is when the market prices the risk as permanent, total, and always worsening. That's when you get the kind of discount that can create outsized returns if reality is merely imperfect. Here's the way to think about JD without getting emotional. You are not trying to predict global politics. You are trying to decide whether the price already assumes a very ugly future. If JD is priced like growth is dead forever, like margins will never improve, like the company will be permanently handicapped, then any stabilization becomes upside. That's the hidden engine, re-rating. A company doesn't need to become a rocket ship to produce strong returns. Sometimes it only needs the market to stop treating it like a disaster. When sentiment shifts from uninvestable to risky but acceptable, multiples expand. And multiple expansion can do a lot of work even without explosive growth. But you must respect the trap. Value in a risky region is not the same as value in a stable region. You should demand more margin of safety. You should size smaller. You should be emotionally prepared for volatility that would scare you out at the worst time. And this is why JD is not for everyone. If you don't understand the risk, you don't touch it. If you can't sleep with headline risk, you don't touch it. That's not weakness, that's discipline. Now, what are the key variables? First, cash generation over time. Not 1 year, a cycle. Does the business keep producing cash while investing? Second, competitive position. Does it keep its customer trust and delivery advantage? Third, shareholder returns. Dividends and buybacks are a signal of management confidence, but they also force discipline. Fourth, the policy environment. You can't control it, but you can watch whether it's escalating or stabilizing. And here's the cliffhanger with JD. If the market ever decides that the discount is too extreme, the rebound can be violent because the stock has been priced for pessimism for a long time. When a stock is down massively from its peak, it doesn't take good news to move it. It takes less bad news. And one more thing most people don't model: time. Even if you're right on JD, you can be early, and the market can ignore you for quarters. That's the price of buying fear. The return often doesn't arrive smoothly. It arrives in bursts, one policy headline, one earnings call where margins don't collapse, one quarter where cash flow snaps back. And suddenly the same people who called it uninvestable start calling it a turnaround. The business didn't magically change overnight. The narrative did. If you can't tolerate that, you size it accordingly or you skip it. Discipline beats bravado. Now, let's go to the third stock. And this one is the most misunderstood because people are mixing up two different things: spending and failing. Oracle. Oracle is one of the largest enterprise software and database companies on the planet. For years, people filed it under legacy tech. Then the cloud era forced a choice: adapt or become a museum piece. Oracle adapted. And here's what happened in the last stretch. Oracle leaned into cloud infrastructure and AI-ready services at a time when enterprises are demanding more compute, more storage, more data movement, and more security. Cloud growth accelerated. Infrastructure growth surged. And Oracle started spending aggressively to build capacity. That spending is what spooked people. When capital expenditures jump, free cash flow can get crushed. Investors see the free cash flow line dip and they panic. They assume demand is weakening. They assume the business is breaking. But sometimes the business is simply investing harder. Operating cash flow and free cash flow are cousins, not twins. Operating cash flow tells you if the machine is working today. Free cash flow tells you how much is left after investing for tomorrow. If free cash flow drops because operating cash flow collapsed, that's danger. If free cash flow drops because CapEx surged while operating cash flow stays strong, that's a bet. And Oracle is making a bet. Build the infrastructure now, capture the AI workload demand, and lock in enterprise customers. Will it work? That's the whole game? Now, Oracle is not a small company. Growth at that scale is harder, which means expectations are everything. If the market prices Oracle like it will grow at startup rates forever, the stock becomes fragile. If the market prices Oracle like it will grow at reasonable rates and keep expanding cloud share, the stock can be attractive. So you have to ask, what is already priced in? And you have to respect the balance sheet. Oracle has debt. Debt plus heavy CapEx means execution is mandatory. If demand slows and spending stays high, leverage amplifies pain. If demand stays strong, leverage can amplify equity returns. That's why Oracle is a knife-edge stock, not a buy at any price name. A valuation story. What do you watch? You watch cloud infrastructure growth. You watch backlog and bookings. You watch operating cash flow trends. You watch whether CapEx starts to normalize after build-outs mature. And you watch whether the business converts spending into durable revenue and customer lock-in. Here's the cliffhanger. Oracle is being judged like a mature company that shouldn't take risks, while it is behaving like a competitor trying to win share. If it wins, the market will re-rate it. If it stumbles, the market will punish it hard. Now zoom out, because the real lesson is not the tickers. It's the pattern. The market manufactures narratives because narratives are easy to repeat. AI is the only thing that matters. Consumer brands are dead. China is uninvestable. Legacy tech can't win. These phrases feel smart. They spread fast. And at the extremes, they create mispricings. Value is born when the story gets louder than the spreadsheet. Crocs is mocked, but it still prints cash and defends margins. JD is feared, but it owns logistics infrastructure that is expensive to replicate. Oracle is underestimated, but it is spending to compete for AI-era infrastructure demand. 3 different stories, same setup. Emotion first, math later. But I'm not here to sell you dreams. I'm here to force precision. Undervalued does not mean safe. Undervalued means mispriced relative to your assumptions. If your assumptions are wrong, cheap becomes expensive fast. So the right approach is evidence. For Crocs, evidence looks like stabilization, core demand, margin durability, and debt reduction. For JD, evidence looks like resilience, consistent profitability, cash generation, and competitive durability. For Oracle, evidence looks like conversion, CapEx turning into revenue, backlog growth, and operating cash flow strength. If the evidence shows up, the discount becomes your ally. If it doesn't, the discount is a warning label. Now, timing. When the market is euphoric, people either stop investing because everything is expensive, or they chase momentum because I don't want to miss it. Both are emotional. The disciplined move is to accept that you can't control the index and focus on what you can control. The price you pay, the quality of the business, and the margin of safety you demand. That's why these 3 names matter in a year when the overall market looks pricey. They aren't the party. They're the side room where sentiment is ugly and pricing can be rational again. But here's the uncomfortable truth. Real opportunities rarely feel comfortable. If they felt comfortable, they wouldn't be discounted. If everyone agreed they were bargains, the price would already be higher. So you have to be okay looking wrong for a while. You have to be okay buying what isn't trending. You have to be okay letting the weighing machine catch up to the voting machine. And here's the final warning. The market will try to shake you out with volatility. It will use headlines as weapons. It will show you red candles and invite you to panic. It will show you green candles and invite you to chase. The goal is always the same. Make you emotional, make you trade, make you surrender your edge. Don't. Your edge is patience plus discipline plus valuation. If you want more breakdowns like this, fast, direct, and built for real investors, subscribe. 1 click. That's it. And in the comments, tell me which one you think is the most mispriced right now. Crocs, JD, Com, or Oracle. Then tell me why. Because in this market, the crowd is loud, but cash flow is louder. And the investors who learn to listen to the cash are the ones who win when the hype fades.